This is our Forex blog for January 17th, 2014. These are our currency indexes, which show you what each individual currency is doing as if it's a chart. These are synthetic index charts that we create ourselves, aren't available anywhere else. And of course, we also have the dollar, euro, pound, and yen. And basically, in a nutshell, you want to buy a currency that's going up, that's trending up, against a currency that's weak. If that currency that's going up is on the top. If the strong currency is on the bottom, like the dollar's going up today and the euro's going down, that means the euro's weak and the dollar's strong. The euro's on top of the euro dollar, so you look for sells. It's that simple. And you can see, the trend is down, and basically you're looking for entry methods into this trend. You kind of draw a trend line on here. When it breaks the counter trend move up, you go short. We either stop right above the high. In this first instance, it kind of goes sideways, so you'd have a small profit, break even. The other entry method we look for is a rectangle breakout. You can see this one, led to a decent 20-30 pip win. You might, in this trade here, have gotten out with a small win or small loss, and then you have another, huge win at the bottom. For those who don't want to have to learn how to trade, you can use our Forex Signals. These are the new ones I'm working on. They work pretty well. You can see sell, made money, went up, made money, sell, made money, sell, made money. It bought here, and it caught an astronomically big move. This is code I was working on earlier today, and I put in a new trailing stop, which is even more effective. It held on to the trade all the way up here. Let me tweak my code and add this back to the chart, and so you can see how the new exit method works during super strong trends. Okay, I just added the new signals back on, and as you can see, what I worked on today and spent most of today working on was, in these super strong trends, if the market becomes obscenely strong, then I go from having a very tight stop, which you can see all the way up until right here, into having a wider stop. And then if the market makes a two-bar pullback or some other things happen, that's a sign that the uptrend is slowing, so therefore I want to have a tight stop again. And you can see I put the tight stop back on from this point onward, and it got out with the trade right up here. And basically, there's so many times where my automated systems catch 20-30 pips, get out, and then maybe a counter trend trade happens where I lose money. And if I was still in the long trade, instead of having a loss, I'd still have a much bigger win. And so that's why I spent all day today doing. In certain circumstances, it widens the stop, and once the momentum kind of slows, usually there's one more wave up. This is an extra 30 pips up. Normally it might only go up another 5 or 10 or 20 pips. This is kind of a rare example, but one that made it worth it for me to spend an entire day working on improving the intelligence of our exit methods. But you can see this trade here, you're in here at this point, and this is your stop, and so that's your risk. And in this instance, this is how much money you made. It's hard to guess, but I would say about 9 or 10 times bigger win than what your risk is. And that's really the key to trading. You can see in this case here, you're short. Here's your initial stop, and you actually got stopped out here. You got a smaller loss than what the initial stop was. Here you got long, and you made maybe a pip. You got out, flipped, went short, and it made this much money. It went long here and got stopped out. You lost this much money. Went long here and got stopped out. You got that loss back plus some. And the key is just bigger wins than losses. Most trades are going to be, pretty small, like this one right here. It was probably 15 pip profit. This one, was huge because it went from 50 all the way up to about 30. You made 80 pips on that one trade. Most trades are going to be 5 to 15 pip wins, because when the market's not going anymore, it's best to get out of this trade. If you hang on too long, you can see that you would have, had a 15 pip win, and if you held on too long, hoping for 30 or 50 pip win, you'd have a loss at this point. If you held on even more, you'd have a 100 pip loss. So you got to take what the market gives. Most trades are going to be very small wins, and some of them are going to be huge. Let me show one more example of how to use the currency index. Again, the real-time trend is very easy to discern by the chart. You have the hourly moving average in gray, 15-minute moving average in green, and underneath it you have the daily, weekly, monthly. So all time frames are up on this one. And some of the best times to buy are actually when the market is going up and then you get a pullback and this tool is at the -80 level. Or the second best trade is when it hits the lower Bollinger Band of the perfect oscillator. If the trend's up, usually these areas are times when the market will reverse, and you can see it reversed, reversed, went up, went up, went up, went up. This is a very accurate tool, and it's part of our signals, why they're so accurate. That's why I call it the perfect oscillator, because it doesn't actually use a look-back period. Most oscillators like MACD or RSI, stochastics, look back over 9 to 14 bars, and if a big bar 14 bars ago drops off, it can really change the indicator. And that's the reason I've always avoided oscillators. I've always hated them because they don't work and they're mathematically unsound. This tool does not use look-back periods. It's also based on real statistics going back 20 days, and we let you see how far the market's up or down. And typically at the 80 level, it's the end of the move, and you can see the market kind of drifted up a little bit more in the dollar and then went sideways and then down. So it's a very good tool for maximizing your profits too. So again, the dollar's up, the euro's down. We saw what that did. Let's look for some other currencies that are trending down today, and we'll look to trade the strong dollar against it. The Australian trending down. You can see daily, weekly, monthly trends all down. The Swiss is trending down. The weekly or the monthly trend's down. The weekly trend's up. So between the two of them, the Australian is a higher probability currency to sell versus a strong dollar. So you want to sell the Australian dollar. And you also, if you're smart, you draw fib tools, you use support resistance, but I want to try to keep these methods simple. This is a move down, typically somewhere between the 50 and 62% retracement you're looking to sell. You might have got into a trade right here where you have a loss. You got into a trade again right here, and you can draw your fibs. Typically, weak currencies will make at least a two-wave move, and so if you got short right here at the close of the bar, let's say 88.03, and you're out somewhere down here, you can see you made about 20-25 pips versus the risk of the trade. It's just drawn on here. If you went short right here and your stop's above the high, you're risking a very tiny amount compared to what the trade would work. So you're literally using our currency indexes, and small losses, big wins can be wrong 2 out of 3 times and still, break even or make money. And that's the key. You don't have to be really even that good as long as you follow our rules. And there's really only 2 entry methods that we look for. One is a pullback trade. This is a downtrend. And you tend to do a little bit better if you wait for a 2-wave pullback. So you draw your trend line on there, you'd be short, and you can see it went your way. Sometimes there aren't 2-wave pullbacks, but these are all instances of how much profit you'd make on the trade. This last one being hanging on to the fib target gets hit. The lowest low is right here, the high is right here, and you can see the market went right to the 1.618 fib target, and barely a pip or 2 more, and then reversed 25 pips off of it. So not only can you use this to trade with a trend, you can use it to trade counter trend. If at this point right here at 10 o'clock the Australian currency index is down, and you can see it is, the perfect oscillator is at a -80, and it's hitting our lower containment band. Very high probability reversal. Let's take a look at the dollar at 10 o'clock. Now, this one unfortunately is not all the way up here, which would be a better sell, but it is at our first containment band. It is at the previous day's high, and it's coming up to the first time it touches the previous day's high. Typically, currencies hit major support resistance areas and bounce off at once, sometimes twice, and usually it's the third time it goes through. Look at the yen here. Previous day's high, it hit it, bounced off. Second time hit it, third time went through. And that's typically what happens, except if there's news coming out, like the pound, just astronomically big move up, and it just took off. So anyway, use the currency index, sell the weak ones versus strong, buy the strong versus the weak. Now you can see that the pound was very strong today, the euro was weak, the dollar was also strong, but not nearly as strong as the pound. But selling the euro pound would have been one of the more probable, trades. And you can see it just absolutely got crushed today. After this initial drop, you have a sell, went down, sell, went down, sell, went down. And that's what happens when you sell the weakest versus the strong. It's pretty easy to trade.